Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
And just a quick but really important heads up before we get started. This explainer is purely for informational and research purposes. It is not in any way investment advice. All right, so today we are digging into a fascinating document. It's a U.S. market analysis, and it's dated March 31st, 2026. This video presents a direct informational narration of the source document. Here's the game plan. We're going to follow the source's structure exactly. We'll start with the big picture, the market overview. Then we'll zoom right in on 5 key geopolitical risks. After that, we'll check the market's fundamental health, unpack the forces that were actually moving prices, look at the technical charts, and then, finally, we'll wrap it all together with the strategic conclusion. Okay, let's dive right in. Section 1 kicks off with a really provocative idea, what the source calls false prosperity. See, on the surface, everything looked great. The market was rallying hard. But the document argues this was just a sugar rush, driven purely by headlines, not a real healthy recovery from the bottom. And hey, when you look at the numbers, it's easy to see why people were getting optimistic. You had the NASDAQ and the Russell 2000 both up over 3%. In the S&P 500, for every one stock that went down, more than 5 went up. And the VIX, which is basically the market's fear gauge, was dropping. That suggests traders were feeling a lot less anxious. And just to put a fine point on it, here's the big headline number. The S&P 500 itself posted a huge gain of 2.91% on the day. So, what lit the fuse for this rally? Well, according to the source, it wasn't some big economic shift. It was just words. President Trump made a statement that signaled a potential de-escalation of conflict. Now, that was a huge relief for the market, especially with everything going on around the Strait of Hormuz and the global oil supply. And then, to add to that positive vibe, Iran's foreign minister came out with a similar statement, saying they wanted a ceasefire. So you had this kind of 1-2 punch of de-escalation talk. Naturally, it calmed a lot of nerves. You could see it in fallen government bond yields and even a dip in energy prices. But, and this is a huge but, the source is basically waving a giant red flag right here. It warns us not to take these statements at face value. The argument is that this is all just expectation management. It's a political game. And while everyone's feeling good on the surface, the real risks are quietly piling up underneath. Okay, so what are these risks hiding in what the source calls the geopolitical shadow? Well, let's break down the 5 specific threats that Section 2 lays out. All right, there's a lot here, so let's walk through these. First, the risk of attacks is shifting over to commercial targets. Think U.S. tech company assets in the Middle East. Second, all this talk of U.S. troops leaving is a bit misleading. They're in a mission lock, meaning they can't leave until certain objectives are met. Third, there's still a very real bombing deadline on the table. Fourth, oil prices are stuck over $100 a barrel, which is a major drag on the economy. And finally, there's this long-term threat that Iran could turn the Strait of Hormuz into a toll road if the U.S. leaves. Every single one of these is a serious threat the market seems to be completely brushing aside. With all this chaos and geopolitical uncertainty, you might be wondering, how on earth do you even navigate this market? Well, Section 3 suggests that we need to anchor ourselves in the fundamentals. And specifically, we need to watch what's happening with corporate profits. So the source basically gives us a roadmap with 3 potential futures, and it all hinges on corporate earnings. Scenario 1, if earnings keep growing, the S&P 500 probably challenges new highs. Scenario 2, if that growth starts to slow down, get ready for a wide, choppy sideways market. But in Scenario 3, if earnings actually start to fall, then this rally we just saw was likely a classic bull trap, a fake-out designed to suck investors in right before the market rolls over and heads lower. So if the rally wasn't about fundamentals, what was really driving it? Well, Section 4 argues it came down to 2 things: robots and rules. The buying wasn't discretionary. It wasn't investors making a conscious choice. It was automatic, forced buying. And we are not talking about a small amount of buying here. The scale was just massive. Because it was the last day of the month in the quarter, U.S. pension funds were required by rule to rebalance their portfolios. And that single event triggered a staggering $34 billion in stock purchases on one day. And just to give you some context on that $34 billion number, this wasn't just a big day. It was historically huge. This single buy imbalance ranked in the 96th historical percentile. It was the 8th largest such event since the year 2000. The source is crystal clear. This must-buy flow was the primary engine behind that huge market jump. But wait, there's more. On top of that pension fund money, you had another major technical factor. A lot of systematic hedge funds, they're called CTAs, had been betting on the market going down. So when the market ripped higher, they got caught completely offside. They were forced to buy back their short positions to stop the bleeding. This created a massive short squeeze, especially in the small-cap Russell 2000 index. It was like pouring gasoline on an already raging fire.
All right, let's switch gears and look at the charts. In Section 5, the source uses its technical model to flash a really clear warning sign. The message is, this is a rebound to sell. It's not a dip to buy. And a big reason for that is what's called an overhead supply zone.
Now, this is a fascinating point, and it really gets to the heart of that whole false prosperity idea. While the main S&P 500 index was only down about 10% from its highs, a whopping 42% of the individual stocks inside that index were already in a full-blown bear market. We're talking down more than 20%. It just goes to show how much weakness was hiding right under the surface of that big headline number.
The analysis points to these very specific price levels where the rally is probably going to hit a wall. Think of them as resistance zones. Why? Well, it's because there are tons of investors who bought at these higher prices, and now they're trapped. They're just sitting there, waiting for the price to get back to where they can sell and just get their money back. For the S&P 500 fund, SPY, that crucial zone is between 653 and 672. For the NASDAQ fund, QQQ, you're looking at 588 to 613.
Okay, so let's bring this all home. Section 6 pulls all these threads together into a strategic conclusion and a look forward. What's the big takeaway from all this?
Well, the source boils it down to 3 core pieces of tactical guidance. First, and most importantly, treat this rally as a rebound to sell. It's an opportunity to lighten up, not a sign that the coast is clear. Second, a real, healthy market bottom isn't a sharp V-shape like this. It requires a messy, sideways consolidation period to build a solid base. And third, for anyone looking long-term, the message is simple. Be patient. Don't feel like you have to rush in just because prices are a little bit lower.
So, to wrap it all up, the source's conclusion is that this rally was hollow. It wasn't built on real strength, but on a temporary rush from political talk and mechanical, forced buying. And that leaves us with the core provocative question the document poses. Until the fundamental geopolitical risk, the whole Strait of Hormuz situation, is physically and substantively resolved for good, should every single market rebound just be treated as a temporary, tactical swing?